Imagine you started investing in 1998. The world was going crazy over the internet. New companies were appearing almost overnight, and investors were convinced they had found the next big thing. So you took your money and invested it into a few tech stocks. Not because they were profitable, but because they had catchy .com names. For a while it worked. Your portfolio kept going up. Everyone thought you were a genius. And then the year 2000 arrived. The stock market experienced a collapse unlike anything seen before. The Nasdaq fell nearly 80%. More than half of all .com companies disappeared forever. Even the richest people in the world weren't spared. Billions were wiped out in weeks. I watched friends lose millions almost instantly. And even though the crash wasn't entirely unexpected, my own investment still took a hit. Here's the important part. The internet was the future. But hype, overconfidence, and speculation created one of the largest bubbles in history. So why am I telling you this? Because when I look at today's markets, I see something very similar happening again. This time, it's not the internet. It's artificial intelligence. People are calling AI a once-in-a-lifetime opportunity. And maybe they're right. But as legendary investor John Templeton once said, the four most expensive words in investing are, "This time is different." So the real question is this time actually different? Right now, the entire stock market is being driven by just 7 companies: Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia. Together, they make up more than 1/3 of the entire S&P 500. That means even if you own a broad index fund, a huge portion of your money is riding on how this AI race plays out. And these companies are spending enormous amounts to win. Tesla is investing billions into autonomous driving and AI. Apple is spending heavily to integrate AI into its ecosystem. Meta is pouring money into data centers and virtual platforms. Google is rebuilding search with AI. Microsoft is funding large-scale AI models and infrastructure. Amazon is investing heavily in cloud computing to power everyone else. Altogether, these companies are spending more than $300 billion in a single year on AI. To put that into perspective, that's more than the entire GDP of many countries. Some people are calling this the next industrial revolution. But there's a problem. Much of today's economic growth is being propped up by this AI spending. Without it, the economy might already be in a recession. So how long can this continue? Global AI spending is expected to reach hundreds of billions per year, and trillions more will be needed for energy, data centers, and infrastructure. That tells you how desperate companies are to win this race. Why? Because AI has the potential to replace or transform a massive portion of the workforce. Whoever controls it gains enormous power. But for investors, this creates a risk. If AI delivers on its promises, we could see another decade-long boom. If it doesn't, the same stocks driving portfolios higher today could drag them down tomorrow. And this brings us to the part most people aren't paying attention to: the AI money loop. Here's how it works. Chip companies design AI chips. AI companies buy those chips. Cloud providers buy massive quantities of them and rent computing power back to AI companies. Then those same companies invest in each other. Money flows in a circle. Each company records revenue. Stock prices rise, but revenue isn't the same as profit. Many AI companies are still losing money every month, despite massive valuations. This doesn't mean AI is useless. It means expectations may be running ahead of reality. And there's another risk. AI has been improving incredibly fast because it has been trained on enormous amounts of human-generated data. But that data is finite. In the coming years, AI may run into what's called a data wall, where progress slows because there's simply less new information to learn from. Markets are currently pricing in non-stop acceleration. If that acceleration slows, expectations could collapse. So is this another dot-com bubble? Not exactly. Unlike the dot-com era, today's AI companies provide real services and real value. They do have a path to profitability. But many classic bubble signs are still present. extreme valuations, massive hype, concentration risk, and unproven long-term profits. No one knows where we are in the cycle, which is why the smartest move isn't panic. It's preparation. That means continuing to invest regularly instead of trying to time the market, avoiding excessive debt and leverage, increasing your income so you can invest more during downturns, and diversifying across different asset types instead of betting everything on one story. Bubbles don't destroy patient investors. Panic does. If you understand what's happening, you won't be running for the exit. You'll be ready to take advantage of the opportunities when others are afraid.